under current liability. SOIP have two types of formats to present. So either you use it as a T form. So this one I derived from the textbook. You can refer. So T form means that here the debit side non-current asset and the current asset is asset. Credit side is your total liability. Liability, as I say, included capitals, non-current liability, and current liability. So at the end of the day, you will see 112, 400, both sides will be same as your trial balance like that. But here, we only focus on the asset and liability. Trial balance will include expenses and income, right? But here is only asset and liability. So you can see here, your asset must the total asset must be same as your total liability. So why there is it must be the same amount for both debit and credit side, because for example, today I go to take the loan, let's say 1,000. So my non-current liability will increase 1,000, and at the same time my current asset, my bank account, will increase 1,000 as well. Then you will ask me why there is a 1,000 in the bank since I owe the bank. Yes, I borrowed the money from the bank, so I could not just put it on the table. I must immediately transfer to my company's bank account. So therefore, current asset increase 1,000 and non-current liability increase 1,000 as well. So there will be tally and same. So if there is not same, means that there is some mistake. Alright, can you see under the capitals? Capital is the opening balance. It could be the previous year profit for the year accumulated into your capitals account, and also included the initial invested amount from by the owners. So every year's profit I'm not going to take out unless there is a drawing. Can you see less drawing after this part, opening balance plus the profit for the year? Then you will get a total and minus any drawing. So drawing, you will see two amount here. One drawing is for the goods, the other drawing is for money. So if draw for money, you will debit drawing, credit your bank. If draw for the purchases, so your purchases will be credit, and then your drawing will be debit. Okay, so it will reduce your capitals when there is a drawing happens. Like example, if you open a business, you start up a business, your main purpose is to earn money, right? After you earn money, you will need to take out all this profit for your own use. So therefore, it is okay to draw money, but there won't be encourage. They will not encourage the partners to take out more. Okay, just now we mentioned about the horizontal way. So vertical way to present your SOIP is like this. So this is the format that usually you can see from online any holding company's website. So such as in the Genting Highland, I will show in the class later. So which is they will show on top here will be asset, and you will see the total asset at the bottom in the triangle after the CA2 red color triangles. So that one is NCA1 plus CA2 equals to the total asset, and then they start again below. On top is the asset, below are capital plus non-current liability and current liability. Basically, at the end of the day, the two red colored triangle must be the same. Same concept as I mentioned just now in the previous slide. So they must be equal, the same amount. If not same, there must be something missing when you put into the transaction, okay, into the record accounting record. All right, so why there is a cost, accumulated depreciation and net book value. Okay, this part you will cover in your chapter 12. For your at the current moments, you will not involved in how to calculate the net book value, but I just want to show you how it's actually shown in your real statement of financial position for any holding companies. So cost column is the total NCA cost. Like example, let's say machine in 2020, the time I purchased is 10,000, but accumulated depreciation means that every years I use for my non-current asset, it will depreciated their value every years of using. Such as motor vehicle is very obvious. Like last year I bought a Proton, let's say Saga is 40,000. Next year this year I wanted to sell it. Do you think I can sell as a 40,000 as the price I bought in last year? It cannot be. So once I use up, then the value will drop. So the net book value is the current market value, estimated market value for your NCA. So the depreciation rate they will provide in your exam paper. So they have three type of depreciation methods to calculate, depends on the question requirement. So the first one is straight line method, second is the reducing method, and the third one is reevaluation method. This one I will further explain in my chapter 12. Alright, so when it comes to the current asset, that will include inventory, but you must put the closing amount, not the opening amount, because everything shown in the statement of financial position is the last date of your total. Is the updated one, not the opening, because in between they will add on some of the inventory and then sell out some of the old inventory. So you need the closing amount only. So trade receivable and less provision for doubtful debt. What is the provision for doubtful debt? Provision for doubtful debt you will cover in your chapter 13, which is the estimated bad debt from my trade receivable. What is bad debt then? You must be a lot of question now. So bad debt is I try to contact my trade receivable, but they are not contactable. They might be run away, they might be declare bankruptcy, they just change their phone numbers and they change their address, everything. So not contactable. I consider this is my I bear the losses. This is my bad debt. Okay, so provision is estimated. If bad debt means that confirm I could not get backs from the trade receivable. I think I didn't include the bad debt here. Once you come to the chapter 13, I will include it. So and then cash and other receivable. Other receivable means that I pay the telephone bills in advance. So the in advance amount not supposed to be this year amount, but I pay to next year. This amount is supposed to be the message or the telecom must refund to me, but they usually they won't, so they will carry to next year. So this is my profit lah, my asset, current asset. All right, and then capitals and liability. So capital is the just now I mentioned already, exactly the same as your horizontal format, but I just put it into different section only. So the first section is about the capital, second section is the non-current liability and current liability. At the end of the day, the total capitals and liability must be same as the amount you calculate in your total asset. Okay, summary of the whole chapter, which is this chapter we cover statement of financial position. So financial statement consists of two types. One is income statement, the other one is SOFP. Income statement is to see how well your company generate profit or making loss for the year, for 1 year. So our basic is 12 months. So more than 12 months you need to minus, less than 12 months you need to top up in your income statement. Statement of financial position is to check whether you are well managing your asset and liability or not, which is liability included capitals, the amount that initially invested by the owners. And the statement of financial position, which is we covered in this chapter, will consist of asset and liability. So total asset must be equals to the total liability, as I show in your slide number 7 and number 6.